Got our lemonade this morning, made by the assistant. Freshly squeezed lemonade. Okay, now let's go over some business, some stocks and finances. So what you want to do, what we got to do today is go over our expenses, which means we got a nice color-coded and laid out Excel spreadsheet of our expenses where we have our bill groups by the year, categorized by type, like internet, phone, rent, mortgage, electricity, utilities, subscriptions, education, banking fees, whatever. We got them nice organized by groups, come down to a yearly total. We can also add in the methods that we pay these bills with, which account these bills are paid with. And then we track our spending like that, our non-bill spending, our extracurricular spending, and sum it all up, break it down into subtotals and then one total yearly amount. And then that's how we track our finances. We track our income that way as well, our net worth, and how much we have per year to save. Color code the totals. So those boxes will be color coded so we can easily see. And that's how we track our expenses. Now we just got to input the data into this spreadsheet, update it, and then we know where we're being charged and stuff like that. What's a company expense? What's a personal expense? What's a family necessity? Food, how much we're spending on food and dine-ins, takeout. So we got that under wraps. Those are our expenses. Then with we have some savings in our savings account. We have some discretionary spending in our checking account. And we have some investments. These could be bonds, which are just safe, trying to get like 3 to 5% a year. So you have some safety in bonds, because when stocks go up, bonds go kind of down, and then when stocks go down, bonds go up kind of, so you're safe that way. You have the futures market on commodities, which is a little bit more like oil, corn, coffee, copper, precious metals, commodities, just bulk. What's in bulk? Oil, silver, gold, whatever's in bulk, you kind of bet on those things. That's for big accounts, like 30K, 50K, 100K. You just bet on one play like that. And you pay off in 8 to 10 months or something like that. But then we have the nice little stocks. And here we have our nice little fun, up-to-date tracking and meddling, playing around with the stock account. What we have, sort of, you track it in your phone. So any purchase you make, you input the date you bought it, the price you bought it at, the quantity you bought, how much value it's worth, and then when you're selling it. And we track it on a chart. I like to use TradingView. I have a premium membership, not a premium membership, just like a basic paid membership. And I like to track these things on the chart to kind of see some technical analysis, some like how the chart's going up, down, support, resistance levels, moving averages, and my indicators, RSI and MACD, which track if it's oversold or underbought or something like that, overbought, oversold. So some technical analysis to expect where the price is going to move just based on the chart. And we can go back daily, we can go back weekly, monthly, or yearly, 5-year, 10-year chart, see how it's moving. But of course, this would mean nothing without the addition of the fundamentals. How is the company generating money? Are they growing in revenue? Are they growing in net income, in profit, in earnings per share? How are their expenses? Then we can get a little more complicated and go into their valuation ratios. What's their price per sales? How has it been moving historically? What's the enterprise value over earnings, EBITDA, earnings before income tax, depreciation, amortization? what's the value of this metric compared to what's the value of price per earnings. That shows you how overbought the stock is compared to how much it's actually generating money. So we look at the valuation ratios to value it. Like, is it too hyped or not enough? And you could also pair this along with the chart. If the chart is exploding like this, and the valuation ratios are skyrocketing compared to its competitors and peers and just other companies in the sector, then we can see it's kind of overbought, and we wait on the chart for a pullback to get in, because there's always pullbacks, and then we take off. And sometimes it moves in sync with the market. So when the whole market pulls back, this pulls back. But if the whole market pulls back and your stock keeps exploding, like Nvidia recently, I made 70% off of Nvidia, then you know that's a very strong stock, because the market is going down and this is still going up 70%. So just time it, ride it up some more, buy more on a pullback, ride it up some more. It takes about 2 to 3 years for a hype sector to die down. Right now the hype sector is AI. It was electric vehicles at one point. It was Bitcoin, cryptocurrency. It was weed and marijuana stocks in Canada when legalization hit. It was the dot-com boom in the 2000s, technology stocks, then oil and gold. So there's always hype sectors. Here's the trick. You may not hear about it until 6 months after, and you think it's too late because the price jumped up 100%. But that's how you hear about it. When the price jumps up 100%, that means it's a hype sector. And then you get in, and you wait it out for another 1 to 2 years, and you make another 100%. And then you get out, and then there's a pullback, maybe you get back in. So when there's a hype sector, you want to be in. You're not too late after 6 months, but then you got to be patient for another year or two, and you'll get a nice profit just like everybody else. You can go a step further and trade options on that. I don't know, that's too risky for me. Like option, you bet a $3,000 and you hope to make a $25K payday or you can lose the whole $3,000 within like a month or a week or something like that. It's crazy stuff. It's betting on bets. So you're betting how the price will move instead of just holding on to the underlying asset. You're betting on a contract of how the price will move. So those are hype sectors and stocks. You also have the profitability ratio. So return on assets, return on equity, return on invested capital. Those are ROE, ROA, ROIC. ROE, ROA are the most. ROE, return on equity, because it's stocks, so it's equity. So that's how the price moves in relation to the money invested. So if you invest like $100, how much did the stock increase? What's your return on capital? What's that judges the past return. So if some stocks are good at that, so you want to have a good stock with that. Like 20% is good, rather than a stock that's negative or 5%. But if you're a more seasoned investor like I am, you might go for a little subtle, simpler strategy. What am I talking about? Index funds. ETFs. I made 10% good cash on Jets ETF. So the entire airline sector dropped because of COVID. But I'm not going to bet on a single airline's recovering, because I don't know which one's going to recover. But I know the airlines industry as a whole is going to recover at least somewhat. So what do? I buy the airlines ETF, which is a collection of all the major airlines. So it doesn't go up extremely, it doesn't go down extremely, but it was very down. And so if there's a recovery, the general airlines industry is going to, as a group, recover somewhat. So I made a nice little 10%. It still has room to go another 20%, but I was satisfied with 10%. So you can buy an ETF, which stands for electronically traded fund. It's a fund. There's no fees to purchase them. The fees are taken out automatically by you holding it. And it's more safer. It's not as volatile. Volatility means how much it swings. So funds are not as volatile. And the big cheddar is the funds of the indices. So you have your S&P 500, you have your NASDAQ, the two main indices of the American stock market. The techs, NASDAQ, and the S&P 500, the big bucks. All you do is you buy index fund, SPY, and QQQ. Those are basically breaking down your money into that index. So the index goes up average 7 to 15% a year. Your fund will go up 7 to 15% a year. Nice, safe, steady gain. When the market drops, it drops maybe 5 to 10%. Your fund will drop 5 to 10%. Your index. What it won't do is drop like 50% to 80%, which is what these big stocks can do. Even Microsoft, even Google, even Facebook, even Tesla, they can all drop 40, 50% just like that in a couple of months. And then you're stuck because you're always saying, it can't drop anymore. It can't drop anymore. It's going to recover. Surely it's going to recover. It will eventually recover, but maybe years down the road. Until then, you're stuck 50, 60% in the hole. Whereas if you had an index, it's going to drop 5%, 10%, because it's huge. It's a collection of all the stocks. Every single stock has to drop 5, 10, 15%. And then year by year, they go up 7 to 15%. So they go up average per year. And then to add a little more gain, all you do is you do the leveraged version of that. You could borrow money, but then you got to pay interest on the money you borrow to invest a larger amount. But what I mean is you get 2-time movement. So when the market goes up, these go up double. When the market goes down, these go down double. So over the long run, it goes up, and you're getting double up. Sometimes it goes down, you get double down. But that's why the majority of your money is in the basic index, just tracks the market, and then you put 30% of your money in the 2 times. So you get a little, boom, extra double movement. Double down, double up. And then you can expect now, instead of 7 to 15% per year, you can expect 20 to 25% per year. And then every 6 months to a year, you rebalance. So when one account grows and one account starts losing, you reshuffle to make a balance. You balance your index funds, your bonds, and what individual stocks from hype sectors you have. That's been my trading strategy. I hold index funds, ETFs, like in the S&P 500, in the NASDAQ, in the 2 times double, and I had JETs. Then I had individual stocks like Disney and Nvidia, hype sectors. Dips are your friend. When the stock market goes down, that's the time to get in because you're going to get a bigger recovery. It's all about your profit. Your entry and exit is greater when you get it on a dip. Doesn't matter if you're buying a hype stock. If there's a dip in the market, your entry and then your exit much greater. So buy dips. So you have your index funds, you have your individual stocks that you use, like profitability ratios, valuation ratios, revenue, earnings, net income. Filter out the best stocks. Buy a couple of hype sectors. Balance it out with some bonds, safe investing, and some ETFs. And that's how you manage it. Then you keep track on your phone. Check it every couple of days. When you got to trim profits, when your stock goes up 10%, 15%, you take some profits off. When it drops 5, 10%, put more money in. So you buy the dip, sell the peak. And then when you make a nice 20% in something, in a stock, or 50% in a hype stock, you can maybe cash out. and then look for a new hype stock. Overall, I like to balance like 70% of my money in safe index funds and bonds, and maybe 20 to 30% in everything else like hype stocks, Bitcoin, anything else you want to invest in. So individual stocks, commodities, cryptocurrency, options, whatever. Make that 30, 20 to 30, 25 to 30% of your money, and make 70% the bulk of your money in safe index funds. And then you have like 70% of that in just the basic NASDAQ or S&P 500, with 30% then in the 2 times double. There's a 3 times triple as well, but that's too much for me. Just the 2 times double. 70% in the core 2, and then 30% in the double, and then with the 30% of the rest of the overall account, hype stocks, cryptocurrency, assets like retail, what's it called? Real estate, whatever. That's how I analyze the markets. So that was our quarterly briefing. Nice little 20-minute video. Now we can get back to our business, churn the money. Get some coffee, eat some food, eat some chicken, some salad. And then we'll see you at the annual dinner. This is Mr. Mladobs, and we'll work on the business. We'll also work on the finance. Stay classy, New York.